Welcome to our webinar today on how do I retire from investment real estate. We have a couple of guest speakers on with us today here at Advanta IRA to talk about Delaware Statutory Trusts and how they work. I know a lot of the people on this call are obviously real estate investors, and so this topic is something I think everyone will learn from, even if you have, whether you have an IRA or you don't have an IRA, you're definitely going to get some great information from our webinar today and from our guest speakers. I am your host. I'm Scott Maurer. I'm the Director of Business Development for Advanta IRA. I've been with the firm for a number of years and have done a number of different roles throughout my time here at Advanta IRA. My educational background is I am a licensed attorney in the state of Florida, although I do not practice any legal work or do any legal work or give legal advice for any of our clients here at Advanta IRA. Just a quick disclaimer from Advanta, and there might be some disclaimers from our guest host as well. But at Advanta IRA, we do not provide investment advice, give any legal or tax advice, or endorse any particular investments. So whether it's something you're hearing about in today's webinar or a future webinar, we do not endorse specifically any type of investment. We're here to facilitate the investments that you bring to us and then make sure things get titled properly and flow properly from a tax perspective. And the information we provide is primarily for educational purposes. We certainly have attorneys and accountants that we can refer you out to if you need those professional resources. A quick background on our company. We've been around for almost 20 years in the industry. We currently have about $2.3 billion in assets under management between our offices in the Tampa Bay area and also in the Atlanta area, but we work with people nationwide. And we really set ourselves apart in the self-directed industry with our concierge level customer service experience and also the different educational offerings that we have, whether you're a client or not. And today's event is simply an extension of that. We do a lot of live seminars, webinars. We host a networking event every other Friday for people to come together and pitch and different deals that they have or that they're looking to get. So we do a lot of those events. We usually do 1 or 2 events a week. We also have a video library. So if you're listening to this call today live, you'll be able to go back and listen to a recording on our YouTube page. Or if you weren't able to listen to this live, you probably are listening to the recording now. So if you ever miss an event, a webinar that we're hosting, you can always go to our YouTube page and watch that. It's a great place to just go and actually look historically and find a lot of different topics and a lot of really good information, not just on self-directed IRAs, but on other topics that we've talked about. For anyone who's new to self-directed IRAs, a quick primer. A self-directed IRA is an account. Basically, it's a retirement account. It could be a traditional IRA, a Roth IRA, the same types of retirement accounts that you can find at a brokerage firm or at a bank. The difference is what you can actually invest those IRA funds into. A self-directed IRA gives you the complete control to choose an investment that you want to have as part of your retirement portfolio. Practically speaking, 70 to 75% of the assets that we hold here at Advanta are real estate-based assets, which is why we brought our guest speakers on today to talk about just another element of real estate investing. The self-directed IRAs really allow you to choose alternative assets and not be pigeonholed into stocks and bonds and mutual funds, actually reach outside of the stock market into other investments that are permitted under IRS guidelines. You just have to have a custodian who's willing to hold it. So if you wanted to buy a rental property or you wanted to make a private loan investment or you want to buy precious metals, you just have to have an IRA custodian who's willing to hold it. And that's what we do at Advanta IRA as a self-directed IRA administrator. As I mentioned, a lot of the assets that we hold are real estate in nature. And I like it when people say they invest in real estate, and I always have to tell them you have to be a little more specific than that, because real estate can be anything from a single family home that you do long-term rentals with, could be short-term Airbnbs, rehab projects, mobile homes and parks are investments we've seen quite a bit lately. There's the checkbook LLC structure. You can lend money on a mortgage loan or maybe a promissory note. There are real estate syndications, the multifamily space where you're not actually buying the whole property itself, but really just buying a part ownership. And there's also what we're going to talk about today, the Delaware Statutory Trust, which is similarly a fractional ownership in real estate. So that's the topic that we're introducing today. We've got two guest presenters, Peter May and Ross Rubin with AlphaStar Capital Management, who are going to get more in depth on DST and Delaware Statutory Trusts. I'm turning the presentation over to Ross now, but I would encourage anyone as we go through the presentation today, if you have any questions for myself or one of our guest speakers, please type that question into the question box on your screen. We will make sure we get those questions answered either when you ask it, or maybe we'll save some time at the end of the presentation. But at this time, I'm going to turn it over to Ross and Peter so we can learn a little bit more about Delaware Statutory Trusts. So how are you guys doing today?
Excellent, Scott. Thank you so much. This is Ross speaking, and I'll take you through the first couple of slides, and then I'll bring in Peter as we go through this. And as Scott mentioned, Peter and I are with AlphaStar Capital Management. However, on this page, you see this logo, DST Sherpa, Find Your Exit, Find Your Strategy. That's our DBA that focuses exclusively on DSTs, Delaware Statutory Trusts. So our friends in compliance want us to share this important disclosures with you. Please just take a minute to read through this. The first paragraph really talks about that the material is for informational purposes only and can't be relied upon for financial, legal, tax, accounting, or insurance purposes. Second paragraph talks about Peter and me and DST Sherpa, which I just mentioned to you. And the third paragraph talks about what it means to be an accredited investor. Some of you may be familiar with the term accredited investor, but there it is as you see it laid out with the income requirements or net worth requirements. Income requirements 200,000, net worth requirement of at least 1 million. So it's an either or situation. So DSTs investors have to be accredited. So moving on from that, there's more information about Peter and myself, and you can certainly get a copy of this presentation should you want to learn more, and our contact information will be included. So here's today's agenda. It's a bit ambitious, but that's okay. We'll probably get through the first 4 sections, the overview, what's a DST, 1031 exchanges, a brief review, and the nuts and bolts. And we want to keep within our time today. And but if we have some additional time, we may go through some DST scenarios. And like I said, the entire presentation will be made available to you should you request it. So I'm going to bring in Peter now, who's going to step through this and the overview. The big question, how do I retire from investment real estate? So Peter, come on board, and why don't you take it from there and tell us why this is more than just a rhetorical question.
Absolutely. Thank you, Ross, and thank you, Scott, for allowing us to present today. And one of the things that people should keep in the back of their mind is the more questions that are raised and asked and answered, it's to stimulate investigative questioning. So what we'll do is we'll get right into it. How do I retire from real estate? The reason we start and end everything with that is if you're going to enter, you have to have an exit strategy. And a lot of times with investors and real estate investors, not enough time is spent on what's the exit strategy, what happens at the end. And the place to think about, do I have an appetite for DSTs, is you're basically moving from being an active investor to a passive investor. Well, gosh, Peter, why would I want to do that? Well, let's say you're tired of collecting rents. Let's say you're moving from the West Coast to the East Coast and you don't want to have rental property that's that far from home. Well, DSTs, Delaware Statutory Trusts, can help you do that because it allows you to get rid of the day-to-day issues of owning investment real estate. And at the same time, it allows you to keep more of what you've worked for and not have to give as much to Uncle Sam.
One other thing I would like to add, Peter, is, and we'll get into it, is the potential for diversification. And I know we're all taught as investors, to diversify, and the DSTs really do provide that opportunity, not only by geography, as Peter had mentioned, but also by property type. So we'll get into that a bit, but I did want to bring that to the forefront. So Peter, tell us what is a DST and where did it come from, and how does it fit in?
This is the exciting stuff. I think I'll just read through the entire revenue ruling and put everybody to sleep. No, back in 2004, that's Revenue Ruling 2004-86, a bunch of smart people got together and made a request to the IRS, and the revenue ruling came out. And what it allows an owner of real estate to do is to sell property one and own property and a piece of property two. And the Delaware Statutory Trust is something that's up and running. It's not as if you're putting your money into a vehicle that's going to then invest in something. So when you think about it, and because of the revenue ruling, it allows a DST to qualify as a like-kind replacement property.
Speaking of like-kind replacement property, let's take a moment and review just real briefly what a 1031 is, Peter. So go ahead and
absolutely
enlighten us.
Keeping it short and simple. So a 1031 exchange briefly is it's allowing you to sell property number one. Let's say it's on 3rd Avenue, sell it for $1 million. And then it allows you to take the proceeds of that investment through a QI, qualified intermediary. So you never actually receive the money. It goes through a qualified intermediary, and then you purchase property two on 5th Avenue for $1 million. And the advantages there are you're getting the opportunity to defer the taxes on the capital gains, because remember that wonderful property, you bought it for $200,000 and it's now worth $1 million. So Uncle Sam's going to want their take of the capital gains and the depreciation recapture taxes. But because 1031 is in place, you get to defer those taxes, take the $1 million from property one, and invest it in property number two.
One of the things that people often ask is, all right, I can defer taxes. What does that really mean? Well, as the law is written now, you can, as they term it, quote, swap till you drop, meaning continue to defer until you pass away. And when you die, your heirs will get a step up in basis. And
correct.
So they won't be subject to the capital gains and depreciation recapture from when you first purchased the property way back when.
And an important point on that, Ross, is the swap till you drop works under the current legislation that's in place, meaning that, again, not tax advice, just reading, when a person dies, their estate is afforded a step up in basis. So we go back to the explanation of the person who had the property number one for $200,000. It's now worth $1 million. If that was the only property in their estate and they died and their heirs sold the property the next day, and I'm truncating this, there would be no taxes on that $1 million sale. So that's where Ross gets the swap till you drop aspect of it.
Hey guys,
So
if I could just ask maybe a quick question on this, and maybe you'll discuss this. But I know with 1031 exchanges several years ago, there was talk about legislatively maybe Congress trying to get rid of the 1031 or eliminate it. Is that something that kind of went away, and maybe what was some of the reasons why why that's not applicable anymore? And again, we don't deal with that as much on the IRA side because IRAs are already tax deferred. But I know, again, a lot of our listeners are have real estate or other assets outside that qualify for 1031s. But is there any risk that this is going to go away at some point, or is it something Congress agreed they should just leave alone and leave it in place?
Good question. Everything works until it doesn't. is what I like to say, because currently there has been in the past proposed legislation that would limit a 1031 exchange to a $500,000 or $1 million. No different, Scott, than some of the legislation that gets proposed and shot down for what you can and can't do with your IRA. Required minimum distributions, what age does it trigger? So what we inform our clients to do is here are the rules as they stand, and work with your tax advisor, your CPA, your tax attorney, and be on top of it so that you know what's afforded to you. Cannot crystal ball and tell you what will happen next year or next month, but currently it's a great deal. And the next slide, Ross, gets into, it's been around since 1921, so it's been there for a while. And it's not a loophole, it's legislatively allowed. There are some specifics in there that, it can't be a flip. And again, this is not the specifics of it, but in general, it can't be a flip, it's a deferment. It has to be a business or an investment. No, it can't be used for your personal home that you live in. And the key question, though, or the key point in there, the third bullet, is the seller cannot touch that cash. So when property one is sold, and I will harp on this a little bit more, but think of the two letters QI, qualified intermediary. That middle person is the only one that can touch the cash. The seller can't touch it. If they do, it can ruin the sale. So, but yes, Scott, everybody asks that question, and depending on whether it's a midterm or an election year, it's always on the table.
Yeah, thanks. Like I said, anyone who's listening live to this event, I encourage you to type your questions into the question box, and we'll get them as Peter and Ross move along.
All right, great. So let's talk more about the nuts and bolts of the DST. And first, Peter, give us the background in terms of who can invest in a DST and how that DST investment plays out over the investment horizon for that particular offering.
Absolutely. For the most part, any entity can invest in a DST. And the key part on that is that if it's owned in a trust, it has to stay in the trust. It has to go from the same entity to the same entity. You can't use it as a distribution tool to get out of, the LLC or the C Corp or the things like that. The other key point on it is it's considered fractional ownership. So on a client we were just working with, they sold a property for a sum of money and invested in a couple of DSTs. And so their ownership was listed as 0.03275 out to 6 or 7 decimal places. So they own a fractional interest in that piece of dirt. And
let me just interject there, Peter, because that fractional interest, keep in mind that typically the DST offerings, these are institutional level properties. Generally on the low end, 30 million on up to 100+ million. And they may be one property, they may be multiple properties within a single DST offering. So that's why when Peter said 0.03% out to 5 decimal points, you can imagine why, because the minimum investment is as low as 100,000. So although you do have to be an accredited investor, you have that fractional ownership of that much larger piece of property, which can be multifamily, it can be industrial, like a warehouse, it can be self-storage or a conglomeration of self-storage facilities, medical office buildings, and senior living, student housing. So you can get a pretty good idea of why I said at the beginning diversification, because those different property types have different, as you go through the economic cycle and real estate cycle, they may have different characteristics in terms of how they react, and we try to build a diversified portfolio for clients that not only by property type but also potentially by geography. A lot of these DSTs are in low tax or no tax states. A lot of it you'll find in the smile states, as they call it, which kind of really in the southeast. Florida, obviously a big state. Texas, Arizona, not too many in the northeast, but for obvious reasons. So it's an interesting dynamic there. Peter, why don't you hit some of these questions or items at the bottom that are...
Absolutely. The one I wanted to start with, can cash be used to invest in DSTs? Yes. Ross has a client that didn't own any real estate and said, this is a great thing. Can I just put some money in? And the answer is yes. The advantage to that is then as that investment grows, besides the cash flow, when it comes time to roll it over, then those gains are locked in so that they can swap or transfer to a second DST as it grows. Duration of the investment, I would like to say typically 4 to 7 years in general, because the sponsors of these investments typically want to find a piece of property, grow it, improve it, sell it, make their money, have their investors, the people in the DSTs, keep the money with, an Inland Capital or a Capital Square. It's not a plug for them. Those are the two that just come to mind. Some of them can last much longer, 8, 9, 10 years. So there is a length of time in it. As far as I know, they're legal in every state as of today. That hasn't changed. And the more important part, do you need a financial professional to invest in a DST? And Ross can add in some clarification, but these are registered investments. So the sponsors cannot offer them, to my knowledge, to the general public. You need a broker, an investment broker dealer, or a registered investment advisor, which is what Ross and I are through AlphaStar.
Yeah, exactly. And I'll just pick up on that, Peter. The DST sponsors, they don't want to take on a lot of the fiduciary role, because it is securitized real estate and it is governed by the Securities and Exchange Commission. So they want to put that responsibility on the investment advisor community, because, well, we're best equipped to do it because that's what we do every day. And the sponsors, what they do is they seek out the property, they purchase the property, they then syndicate the property out through investment advisors, and they manage the property, and they determine when it's most optimal time to dispose of the property. So that's really the collaboration between the DST sponsors, and there's, gosh, upwards of 40 plus sponsors now. Quite frankly, some are newer to the market. Just from Peter and my perspective, we'd like to focus on in our sub-advisor on what we call the blue chip DST sponsors who have been around, have the track record, have the depth and breadth of expertise, have the management, have the balance sheet, et cetera, and have demonstrated that they can go full cycle, meaning they've done the upfront and they've gone through the entire process multiple times of buying, syndicating, managing, and disposing, and have a track record to demonstrate that. So No, part of our role is to, and our sub-advisor is to vet the DST sponsors and the offerings that they bring to the table. And, the DST offerings, there may be 10 or 20 DST offerings at any given time, and they're subscription based. So, like I said, let's say if they're looking to raise 50 million in equity. Once they've raised 50 million in equity, that DST is now closed, and we move on to whatever the remaining or available DSTs are at any particular time. So it can get very interesting in this current market with a lot of transaction volume happening. A lot of these DSTs that they may have 50 million today, and we've seen them that 50 million kind of get subscribed in a very short period of time with very large transactions happening. However, like I said, we can accommodate down to $100,000, or the DST sponsors accommodate down to $100,000. So that gives you a little bit of more. And then back to the cash be used to invest in DSTs. That can be both non-qualified money as well as your qualified IRA money. So it spans the gamut there.
Yeah, Ross and Peter had a couple questions pop up, I think, kind of talking about what we're right here, the DST nuts and bolts. Someone asked kind of, and you kind of referred to the sponsors. So someone asked kind of who sets up the DST, and I guess that's going to be a sponsor. Maybe we'll give a little more detail. Is that just larger financial company or real estate investment firms that typically set those up?
Yeah. These are large real estate investment firms, and they basically they'll go out, they'll acquire the property, all right, and they'll seek if they're the financing if they wanted to create a debt on the property, because a lot of times people are, in order to complete a 1031 exchange, they may have debt on their existing property, which they will need to replace, and the DST sponsors arrange for the non-recourse debt on the DST. And like I said, there's about 40 or so DST sponsored. Peter mentioned a couple: Inland Private Capital, Capital Square, are two that why they come to mind. There are two that we've used most recently, and there are a number of others that we work with. So they have already done all the legwork for you, the investor. They've done it all, and they also have a team that manages the property or partners with a property management group that handles that. So they keep the eye on the ball as we go. So these are large companies that do bring these offerings to the table for syndication for individual retail investors. Peter, is there anything I left out there that you want to add, or?
Well, no, I think the key piece on it, and you can, when I say jump to the next slide, it will answer the piece of Scott's question is, how does it all work and how does it all come together? Is, DST Sherpa with our sub-advisor, we help scrub these, meaning of the offerings, which ones pass our internal tests, which ones just aren't. There's oil and gas DSTs. That's not in our bailiwick. We like to stay above ground. Going below ground, it doesn't mean they're not good. It's just that's not our area. And so part of it is, the way I like to think of it is, let's take Inland Capital. They go out, take 30 million of cash, get 30 million of debt, and buy a $60 million building that they fix up, get operating, and it's up and running, and there's a history to it. There's a nice PPM, private placement memorandum. And so from there, what ends up happening is we review, they've got pictures, they've got financials, and the client says, you know what, I'd like to take $1 million and put it into that DST. So from there, they're now looking at it, paperwork, all those things go forward. Item number 3, how many DSTs are available? and how many may be selected depends on the time of year, what's out there, and what some of these providers are doing. A key piece in the property selection is how is debt replaced on the existing property. So let's go back to the $1 million building that we sold, that we bought for 200. Has no debt, sold it for $1 million. Now we buy into a DST that's 50-50 levered. Back to the 30 million of cash, 30 million of debt. That means for my $1 million of cash for the client, they're also getting $1 million of non-recourse debt. So it's as if they took and bought a $2 million building that already had the financing in place. The beautiful piece about that is that you sold the building for $1 million, you bought a $2 million building, now you have a new $1 million of depreciable basis, which then means there's opportunity for additional tax deferral, those kind of things. Item 5, are some properties more recession resistant than others? Sure. There's also people, we have had a client that didn't want to buy anything in Florida because they thought global warming was going to flood the state. That's not a statement on the political or anything there. It's just everybody has their blockers and their qualifiers for what part of the country or what type they want to invest in. So that's, when I say it in a nutshell of the process, the key piece on here, simply back to the 1031, is once the person's in cash, so they sold the property, one of the key pieces is you have 45 days to identify a replacement property. And that's the part that turns it a little bit into a pressure cooker, because you're trying to evaluate what investments are available and which ones meet your threshold test. So I think that answers your question, Ross and Scott.
Yep. And actually, I was gonna say, Peter, actually, what you just said brought up one of the other questions we had. Someone, the 45-day kind of identification period with a 1031. Someone questioned, said, does a DST have to be in place before that sale, the 1031 sale, or is it something they need to identify during that 45-day period? So if a DST was formed during that 45 days, you could simply take advantage of that particular property.
Great question. I'm going to add a little bit of clarification. So let's say the $1 million property sold on day 1. That DST typically has been up and running for months, or at least a couple of months, and it's operating. So when that client takes the $1 million on day 1, because they just sold the property and they're in cash, if they 10 days later say, you know what, I like this multifamily in Florida and I want to buy it, the money gets placed and their cash flow starts for the balance of that month, and then they get checks every month thereafter. So it's not as if you're putting money into a pool that somebody's then deciding what to develop. Does that answer your question, Scott? Hello?
Yeah.
Yeah, I'm sorry about that. I had just an issue trying to get with my screen there. Yeah, no, it does. That answers the question. I didn't go anywhere. Yeah, I was just having trouble finding the unmute button.
Okay, that's all right.
I think it does. Yeah, and I think someone asked, kind of, could they start their own DST? I guess in theory you could, but as you mentioned, DST sponsors are, big real estate firms in various different industries. Correct? It's an individual could just say, I'm going to start my own DST and just name a property.
Well, I'll answer that very limitedly, meaning you could, if you had the right property and the right administrative counsel, you could theoretically create your own DST. I think what people get confused on is you're selling property number 1, it's now in cash. Now you're looking for a replacement property. The place where DSTs come into play often is as a backstop for a 1031, meaning you've sold building number 1 or you're going to sell it, and you've identified building number 2 down the street, but it hasn't passed inspection, or there could be something happen. What happens if building number 2 has issues with it? And I'm jumping a little ahead, or if the numbers don't match up. You sell for $1 million and the replacement property is $800,000. What do you do with the $200,000 a boot? But so that's part of it. Theoretically, and what I'd like to do is if a person has that question, Scott, please forward our information to them, because that is something that there are people that do private DSTs because they have the resources and the capital to do it, and they just want to keep it private.
Okay, we have a couple other questions that come up. I think you're probably going to touch on some of them as we go through, so I'm going to hold those questions. People had, just exiting DSTs, can you roll over the proceeds, things like that, and maybe questions on fees. But I'll let you keep going, and we'll, like I said, I'm sure you're probably going to answer some of those anyway as we go.
Yeah, probably, and I think this may bring to light some of the things, the pros and cons. We went over a number of the pros. Let's focus on the cons. If you need, you're selling a building and you need the funds to, you're going to need the funds in the next year or 2 or 3 or 4. You want that liquidity, then the DST isn't for you. They're not liquid. Look, there is a sort of secondary market for DSTs. It's not very liquid. You're not going to get 100 cents on your dollar. We tell people, look, there's just a lack of liquidity, and if you need funds, either don't invest those funds in the DST, hold them back, pay your taxes, or don't do a DST altogether. Secondly, if you like being a landlord, if you're building your real estate empire and you're growing from a real estate perspective in terms of acquisitions, and you manage it, you enjoy it, or have a team that does that, then the DST might not be for you. And third, last but not least, this isn't really a get rich strategy, as we say. It's more of a stay rich strategy. There are opportunities for appreciation on these properties, but the idea, you're not going to double or triple your money in 4 to 7 years, like Peter had mentioned. We can share with you the track records. You see property values do whatever the market does, and remember, these are stabilized properties, that sort of thing. So those are some of the reasons why we tell people a DST may not be a great fit for them. Peter, do you want to go over anything else, some of the other pros that we may not have hit on here?
Well, I think one of them, and it kind of goes into the pro/con, it's kind of a joint category, is, if you have only 1 or 2 properties, then, and you're needing leverage, you're needing cash flow or debt, then this is not something for you. The place where that does come up is, let's say you own 10 or 20 doors, let's say 10 doors. And of those 10 doors, 1 or 2 of them are more problematic than others. And we've seen people that what they'll do is by doing the DST strategy, take those 2 doors and sell, reinvest in a DST, because they're just not sure where they want to go, but they do know they want to get rid of 2 of the 10 doors. And probably the estate planning standpoint, and we ask this question, and it's come up with a number of clients, is what's your exit strategy? The pro at the bottom of, you don't want to pass away and leave this to your kids. Well, this makes for a very good transition, and in certain situations makes for a great philanthropic opportunity that we may get to today, or I can follow up with later. But there's a number of pros. It's something that should be talked about. It should be investigated, and then fill it or kill it. Decide if you want to do it or if you don't, but then at least you have the information in your back pocket. Back to you, Ross.
Okay, great. Scott, did that hit the questions that were out there? Anything else that went
Yeah.
unanswered that we can address?
Yeah, I mean, I guess maybe we're on pros and cons. One of the other questions had, obviously, with 1031 exchanges, you defer the capital gains. Somebody asked, are there any other tax benefits that are passed on to the investors, like depreciation, with these types of investments?
Well, good question, and I'm going to try to answer it. The depreciation because of the non-recourse debt is a new or an additional advantage. Again, back to the example, you sold for $1 million, you bought it for 200,000, so you probably fully depreciated the property. You have this large capital gain, and when you sell, you take your $1 million and you invest in a 50% leverage. So you now have a $2 million building that you spent $1 million of your cash, and then you acquired $1 million of non-recourse debt. That's additional depreciation that, depending on the DST's approach to cost segregation and accelerated depreciation, creates additional depreciation for the client. So they're in a better position than they were before. And that's something that when I say their tax manager or their CPA can help plan and strategize for.
And also, Peter, we can't forget, you also get from the original property or the disposed property, you do get the carry forward depreciation
if
going forward,
if
it's still left over.
So if the $1 million sale was because of a building that was built or purchased for 500,000, you still carry forward the depreciation from the initial building, and you acquire any new depreciation through the non-recourse debt. So it's a win, and it's something that's there. Probably the challenging part is understanding where your current portfolio is, and understanding, for the 8 buildings I own, what's the basis? What's my depreciation recapture? What's my potential capital gains? What are those things, so that if I pulled the trigger and sold, or somebody made me an offer I couldn't refuse, what's my tax / cash flow / estate impact? And the reason I say that, and it's not in the slide, Scott, but it's our approach, what we refer to as the 4 quadrants. And really, any decision you make, what it should do is it's going to impact your taxes, it's going to impact your cash flow, it's going to impact your investments, which is your real estate, and then it's going to impact your estate preservation. So these are all components of it. Back to you guys.
Right. Yeah, thanks for the answer. The one other question I had, I was going to try, maybe we can get in. I know you guys have some scenarios or things you want to kind of put some more illustration behind the topic. But someone asked they said simplistically, our DSTs are institutional level real estate syndications. And when we do a lot of our webinars, we talk about real estate syndications, like on the multifamily apartments, where it is kind of one property. Correct. But so these are like institutional level syndications that somebody can 1031 into.
Yeah, and that's exactly what they are. Yeah, absolutely, Scott. They are institutional level syndications. So for example, there's one we did not too long ago for a client. There's a $150 million DST offering syndication on an industrial and Amazon distribution center, or 2, one in Fort Myers and one in which survived the hurricane without any kind of significant damage whatsoever, and everyone was okay.
No insurance claims.
No insurance claims, exactly. And a second one in Kansas. So exactly that. That is an example. So they own a piece of that Amazon, or a piece of those 2 Amazon locations. Multifamily, same thing. What we've found also, and I think everyone's seen it, the single family rentals. Obviously, that's been the hot topic, and we've seen private equity involved in that. We've seen DSTs become involved in single family rentals. They'll be built purpose-built single-family rental communities. There's one DST right now, I think still has availability. There's right outside the Charlotte, North Carolina area, right in Charlotte, a purpose-built community, 84 single-family residential homes, that sort of thing. So student housing, senior housing, et cetera. I can, the list goes on. So these are just that. They're ranging from 30 million to 150 million, generally institutional level real estate across geographies, across property types.
Okay, well, why don't you guys go anyway? Like I said, we have a couple more questions trickling in, but I'll save those for the end and let you go through some scenarios, and we'll wrap up with a few questions at the end.
Okay, great. Yeah, so
go ahead, Ross.
Yeah, no, I was going to say, we have there's a bevy of scenarios we have here. We may have touched on pieces of each of them, but we do have some time to go through these. And the first one is a basic one, and Peter, you may have touched on it as we went. So someone has a debt on a property, and as you had mentioned, the debt, you have to replace the full value in order for a 1031 to go through and take advantage of the full tax referral. And so if you have a couple $100,000 of debt on the property, you either you have to account for it somehow. So you can take us through, Peter, how that works on the DST side.
Well, absolutely. So you have your, like the example alludes to, you have your $1 million building that, let's say, you bought for $800,000 or whatever the price was, but you have a $500,000 of debt, and somebody's making you a great offer. Well, in order to do that, that debt is as if you received cash, and so you may be able to go out and get your own financing, or it may be an easier layup just to sell, take the cash, and find a DST that has enough leverage. Some DSTs are zero debt. Some are up to 65 and 70% debt. It just depends on how the numbers work for that specific DST provider. So, that's the financing obstacle. I think, Ross, for the time we have, we can rapid fire on some of these. Number two, the backup plan, is where we're brought in very often and a DST does not end up being used. So you sold a building for $1 million and you've identified another property, but what if that property falls through? Something's wrong. It doesn't work out the way it is. Well, wouldn't it be nice to have a DST as a backstop for that? And a lot of people will do that. They'll use it as the backstop. Number three, that follows right behind that, is what we call the table scraps. You sold for $1 million, you found a beautiful replacement property for $850,000. You can either try to overpay for the one you're buying, or take the 150, park it in a DST, because if that 150 was boot, you'd probably lose at least a third of that for taxes. Again, I'm just guesstimating. So why not take the 150, invest it, and get some cash flow out of it versus reducing the debt, national deficit. Number four, maintenance costs. Again, back to the example of your 10 doors, you know which ones are gems and which ones are dogs. And that's part of the process of saying, here's how we'd like to do this. And it really works. That would be the piece, you know which ones are the producers. Unproductive real estate, similar. A lot of people use this with raw land. You bought it for $1 million, you bought it for a price, and it's actually a cash drain because you're having to pay the taxes on it or some of the maintenance costs, and it's not producing cash flow, and it never was going to produce cash flow. But you've now gotten the offer of your dreams. Take the cash, invest it, increase your cash flow. We've had some people that on a property, for example, they had a cash flow of $10,000 per million and it increased to 30 to 40,000, independent of tax ramifications. Get rid of your dogs. Maybe now's the time. Swap till you drop, we talked about. That's the estate planning or the estate component of it, as long as you get step up in basis, which currently you do. You sold the property for $1 million, you'd have to pay taxes. If you keep the property till you die, your heirs don't have to pay taxes. However, you may not have the intestinal fortitude or the patience to be managing property when you're 75, 80, 85 years old. So that's the swap till you drop approach to it. Diversify. Let's say you have a $5 million building and you'd like to own real estate in different parts of the country. It's a great way to do it. It's a great way to have a balanced real estate portfolio that can be, and then the other piece on it is that you can end up having almost a laddered portfolio, because let's say they all don't roll over at the same time. Now you're actively doing it. What Ross had on the next one gets back to the swap till you drop. Everybody, and as a former CPA, former tax attorney that did exit planning, everybody says, well, I'm just leave it to my kids. Can't tell you the number of business owners that have never talked to their kids on whether they really want it or not. And so you end up having a fire sale because the kids are in one part of the country, the property's in a different part, and they just want to sell it. Why not have these active, meaningful conversations while you still can call the shots? And then the last two in there, or the last few, it's an estate planning tool. Again, swap till you drop, allows you to talk about it. The better one that we like is number 10, the retirement plan. You're creating additional cash flow. You're helping the situation. You're managing it actively while you still have the ability and the decisioning to do it. Hey, Scott, any other questions? I don't want to keep, I can rattle forever. Trust me, I love talking about this. But I just want to make sure that I'm doing a check-in.
Sure, I think we have a couple of questions here at the end, and then obviously going to your summary would be good. I guess again, someone asked earlier how you exit a DST. I know you mentioned there's a typically a 4 to 7 year maybe hold time. So do DSTs close and all the investors go, or if you subscribe to a DST, you have to hold for a certain time before you can then sell your interest?
Well, you will sell your interest. That's a great question, Scott. You will sell your interest when all others sell their interest, and that is determined by the DST sponsor. And like Peter said, remember, the DST sponsors, their goal is to maximize the return to the investors. Because why? They want you to invest in them with them again. And so, you, like we said, if you need liquidity sooner than later, or you don't want that, you want to be in control of that, a DST is not going to be for you. However, if you're okay with that and understand how the process works, and it can maneuver within that time frame, then you'll be liquidated, and you have the opportunity at that time to go into to a 1031, traditional 1031. You find a property on your own, you can do that. You can invest in another DST, or you could take the cash, take the money and run, pay your taxes, and on the way you go. So you do have those three options at the conclusion.
Sorry to interrupt. Ross, if you can back up 2 slides, number 12. This is a nice little secret, or a thing to, when I say tease the audience, people talk about 1031s, and this one we can just read off. 1033 of the code, fire, eminent domain, and other casualty. So you own a building and it was burned down, or a hurricane hit it, or eminent domain. So the code section is a little bit different of what the time frame is. I won't go into that, but this is a DST is a rescue in situations of 1033s. So you had a business, or not a business, you had a building, it burned down or whatever, and you have a period of time that you have to replace that. And if you don't, you pay the taxes. So we've had a few of these where people have inquired because they just wanted to be able to use it as a backstop. I reference this and make a mention not to turn the conversation into these topics, but just to say it's out there when bad times hit.
No, that's great. So let's just take a minute and summarize as we're getting close to the top of the hour. As we said, the DST can be used in a 1031 exchange. We talked about that. We talked about offering the diversification, cash flow, potential appreciation. Talked about the tax advantages and the fact that we can eliminate those landlord responsibilities. We talked about the estate planning aspects with the heirs being able to inherit the DST proceeds, income tax free, and you need a financial professional in order to transact and access these DSTs. Section 1031 exchanges, they are complex and strict rules must be adhered to. That's why we always recommend anyone entertaining a 1031 exchange, find a QI. We work with a number of QIs, find a QI qualified intermediary. They know 1031 exchanges backwards, forwards, sideways. So a qualified intermediary is a great resource. And DSTs offer a potentially favorable exit strategy for owners of an appreciated investment real estate. And that's really why we wanted to share what we did share today with everyone. Any final comments, Peter?
Give us a call. We're happy to discuss. We're happy to educate. And it is an opportunity that people should know more about. And it's okay if they don't, because it allows them to be more in control of their estate and their investments.
Yeah, Ross, Peter, thank you very much for coming on. I said, one of the questions I know you hit on a minute ago that was left was someone asked, can you roll your DST sales proceeds into another tax-deferred investment? Which, yes, you can. You mentioned that you can certainly go right into another DST, another piece of real estate, what have you. Right. Someone asked, is there a recording of this we can access? As I mentioned at the beginning, yes, we record all of our webinars. So this webinar should be up on our YouTube channel either later today or tomorrow, and we will actually send an email with that recording link out to everyone who listen live. And if you want a copy of the slide presentation, you can certainly email myself, or if Peter Ross, if you want to put up your information again here on the slide, so they can reach out to you with any questions they have. Obviously, to either get a copy of the slides, or even if you just want to ask some more questions about DST, certainly reach out to either Peter or Ross. Again, AlphaStar Capital Management. Any final thoughts, gentlemen?
No, Scott, thank you so much for your time and ability to help educate your audience, and thank everyone for listening today. And look, we're here to help, as Peter said.
Absolutely.
Okay. Yeah. Again, well, thank you all very much. And if anyone has any questions on self-directed IRAs, you can certainly reach out to me. Again, as we mentioned, you can invest your IRA into a DST. You maybe not get the same tax benefits that people would get with a 1031, but if it's an attractive investment and you're an accredited investor, you could certainly look to do that, and just reach out to me to find out how. But again, thank you, Peter, Ross, coming on. Again, maybe we'll have you back in a few months and kind of maybe dive a little deeper into it.
Absolutely.
Awesome. That'd be great. Thank you.
All right, great. Thank you. Thank you, everyone, for listening today. We look forward to having you on our future webinars.